Let's take a brief look at what free cash flow is. So generally when we talk about free cash flow, we are referring to technically free cash flow to firm, or in other words, FCFF, or it's sometimes called unlevered cash flow. So in practice, you're going to be finding these terms used interchangeably. The definition of free cash flow is the free cash flow that remains after covering all necessary costs for the company and what is left to distribute to the creditors and the shareholders. So it excludes every necessary cash flow for normal operating and investing activities of the company. So if you see the formula, we start from operating profit. So you can see that we have already excluded costs like labor cost, cost of goods sold, marketing, R&D. We've excluded everything that's related to operations. But if you think about the investor's perspective, even if you're a creditor or a shareholder, can we claim everything that is left from operations? No. We have to deduct mainly three more types of cash outflows. Number one, we have tax. So the investors cannot, claim tax. It has to be paid, and this part is untouchable. Number two, we also have to set aside some, amounts for future capital expenditure. So the cash outflow from capital expenditure is generally also sought as untouchable from the investor's point of view. And of course, some people do include capital expenditures on intangible assets or some cash outflows related to mergers and acquisitions as well. So, depending on each individual analyst, some people prefer to use lower numbers for capex. Some people go more conservative and use higher numbers on capital expenditures. So depending on who calculates free cash flow, basically the results can be different. Lastly, what's untouchable from free cash flow is net working capital. So whatever cash is needed to support the company's operational day-to-day business, that also is considered untouchable from the investor's point of view. So these three items are subtracted, so tax, capital expenditures, and net working capital. But lastly, we do also have to make some add-backs like depreciation and amortization, because where we started was operating profit, and as you know, operating profit is not cash-based. It's an accounting-based concept. So we have to add back some non-cash expenses and make it as close to actual cash flow as possible. So in this case as well, some people not only include depreciation and amortization, but other non-cash costs or non-cash expenses can be considered as well. So yes, the final results of the free cash flow calculation, it can be slightly different depending on the person who's calculating it or the institution that's calculating it. And one more thing worth noting, I think, is that this formula that you see right here, it can be different. Some people start from operating cash flow. Some people start from net income and add back cash flows and expenses. But personally, I think that in practice, the most frequently seen formula is the one that we're seeing right now. So I think unless you're preparing for CFA exams, even for technical interviews, I think if you remember this version and if you have the strength to go and reconcile EBIT, depreciation, cash flow from operations, it shouldn't be a very big problem. Only remembering this specific formula, starting from EBIT, I think it's sufficient enough. Next, we do also have a different type of free cash flow. It's called free cash flow to equity, or FCFE, or it can be also called as levered free cash flow. This time it refers to free cash flow attributable only to the shareholders. So what happens is we remove the creditors portion from FCFF and we get to FCFE. So what is additionally removed is, number one, the interest part, because now this part belongs to the bondholders or the creditors. And lastly, any net borrowings, it can be a plus or it can be a minus, but anyways, this part of cash flow, it belongs to the creditors. So this is also calculated, and we finally reach a concept of free cash flow that is only used or distributed to the general shareholders. But one thing worth thinking about is, if we use free cash flow, so what is our final goal of this DCF valuation? What are we trying to calculate? Well, usually you're evaluating stocks, and so the final mission is to calculate equity value or equity value per share, and you want to compare it to the current share price and decide whether the stock is overvalued or undervalued. So if you're going to equity value anyways, you might as well just use FCFE, discount it to cost of equity, and you're going to get to equity value straight away. But if you use free cash flow to the firm, what you have to do is you discount free cash flow to the firm with using weighted average cost of capital. You get to enterprise value. And if you get to enterprise value, you have to convert the enterprise value to equity value by subtracting net debt. So using free cash flow to firm is a more complex way to, its methods go around a little bit to reaching our goal compared to using FCFE directly. But you can see in most, I think 99% of the DCF valuations, we use FCFF. So if you consider this an interview, how would you explain that? So despite the fact that FCFF is more complex, most people are using FCFF. Why is that? The answer is, well, there are different opinions on this, but I think generally the most persuasive answer is that net borrowings, this is very tricky to estimate. As we've seen in our Financial Modeling 101 course as well, it was very tricky to forecast how much money the company would newly borrow or newly issue, simply because future numbers is not a reflection of the historicals. For example, if we had revenue or operating expenses or labor costs, usually our logic was that looking at the historical financials or looking at other companies or looking at the trend of the top line growth on revenue, we thought that expenses would increase accordingly, or capital expenditures are going to increase or decrease accordingly. Those kind of logic was not applicable for borrowings. But depending on how much they borrow, FCFE is going to fluctuate substantially. So that's the reason. It's very hard to predict. That's why we rather use FCFF, convert to enterprise value, and then convert to equity value. Because for net debt, we usually have the current number that is fixed. All right, returning to FCFF, so which factor do you think, which component do you think is the most crucial factor among increasing a company's value? Well, ultimately, of course, EBIT has a significant impact. That is the reason why we spend so much time on the three-statement model, and actually forecasting operating income. On the other hand, tax, there's not that much that we can do about it. It's pretty much always fixed. So it's not going to make a huge influence. But capital expenditures, the numbers are, well, depending on the industry, the numbers are, usually it's big. So capital expenditure can be considered very significant following EBIT. But, well, in the long term, the more capital expenditures, the more depreciation and amortization. So it somewhat has a netting effect. So that's one thing more to consider. Net working capital, although in some industries it can be very substantial, usually the impact, I would say, is smaller than the other components of DCF. Fortunately, if we already have the three-statement model, which we have completed, all of these components are already forecasted up to 5 years. So all we have to do is to link each item to the required formula into the DCF model and calculate. So we've now briefly covered FCFF on free cash flow. Now let's move on to studying other issues.